and welcome. My name is Stefanie Linhardt, Europe editor at The Banker, and I'm here with Simon Lewis, the CEO of AFME, the Association for Financial Markets in Europe. Now, Simon, Brexit is a big topic all across Europe. Everyone's talking about it. AFME have just published a report on the implications for wholesale banks, for their clients and supervisors to do with the implementation of Brexit. Now, what are the key findings from that report?
Yes, we're calling it an implementation report because now Article 50 has been triggered. We're into the 2-year process, and I think the biggest finding is it's a very short period of time to get it done. So there are probably 3 main areas. There's operational complexity, there's regulatory complexity, and there's legal complexity. And what the report says is we have to get on quickly with addressing those 3 areas. If you think of how complex the banking industry is, making changes in terms of activities, in terms of products, in terms of location, takes a lot longer than other industries. And I think that's the core finding, just the sheer challenge of the operational complexity and therefore the need for a number of different responses from policymakers to help make that happen.
Well, what recommendations would you give policymakers in that case, especially when you look at the access to providing services within the EU 27, market functioning? What would you recommend?
Well, probably the single most important thing is phased implementation. I think the clear view of the industry, and I think actually from policymakers, is it's going to be very difficult to do all this within 2 years. What we must avoid is a cliff edge where after 2 years everything changes and people aren't ready. So phased implementation, and we can have a discussion about how long that might be and what it might mean. But we're encouraged that both the UK government in the Prime Minister's letter and the EU response both seem to acknowledge that that is an important aspect. Now, what that actually means and when it's introduced is another matter, but I think that's the single most important thing. We must phase the implementation. And if you ask me to choose a number, I'd probably say 3 years, so the 2-year period plus 3 years would get us probably to a more comfortable phase, but we don't know yet.
What would you say is the first step of the implementation process then?
Well, the first step is to get in place what our members have to do to get ready. And that's a number of things. That's thinking, and it depends obviously on the business model of the firm concerned. For some of our members, it's a relatively modest set of adjustments because they have options already by dint of the way they're organised. For other members, it might mean quite significant changes, a new subsidiary, recapitalising another part of the EU. So it really does depend on the bank concerned. But by and large, I think this is very important, our members have got their contingency plans in place. It's just really a question of when they implement them.
And when you find out additional information that you can work with.
Exactly. And obviously at the moment we're still in the very early days, and here we are in April. I don't think Michel Barnier, the chief negotiator, gets his mandate until the end of this month. Then there may be a pause. There's the French elections, the German elections. I think there's a growing sense of, goodness, 2 years is going to fly by.
Everyone's talking about London, its financial centre, its special status. Is London going to keep this status, or is one of the EU countries' markets going to snap it up?
Well, I think it's rather good that the other European centres are presenting their wares. I mean, Frankfurt, Paris, Milan and Madrid all have financial services activities within their cities, and they are obviously explaining to people why they think they have a good case. But the reality is London is not just a financial centre, it's a hub. It's a hub for professional services, it's a hub for a range of activities. So I think London's role is pretty rock solid, and clearly London, 80% of capital markets activity already goes through London. So my sense is London will retain a very important role. The key post-Brexit is to ensure that London is still connected enough to the rest of the EU that we're able to serve our customers across the EU. And that obviously is part of the challenge of working out the exact arrangements that enables London to continue to contribute to the EU economy.
So if London is going to lose out, which cities do you think will gain from this?
I think it's interesting. London, there's no doubt that some jobs will move from London, and we've already seen announcements from a number of our member firms saying that people will move activities, and that's inevitable given the nature of what's going to happen post-Brexit. But Frankfurt, I think, will grow in importance because of the ECB. In fact, AFME's just opened an office there because we think it's really important to be closer to the ECB. Paris, inevitably, Milan, Madrid. These are all powerful financial centres in their own right. So I think we'll see each of those cities, and Dublin, taking a little bit of activity, but I do think London will remain the core European financial centre.
And talking about the European Union, I've spoken to Valdis Dombrovskis, the EU Commissioner for Financial Markets, last year after the Brexit vote, and he then made the point that CMU is now more important than ever. The Capital Markets Union, that is. What do you think will happen to the Capital Markets Union project, though, with Brexit now happening?
Well, first of all, we completely agree. We've always been big supporters of the Capital Markets Union project, not just because it's a good, interesting name, but actually the basic issue it seeks to address is the over-reliance on bank finance. If you're a small or growing business in any country in the EU, you tend to rely on your local bank to finance your growth. And we know that banks' balance sheets are shrinking, it's becoming more difficult to lend. So there has to be a new way to enable particularly small and growing companies to access pools of capital. So that's a fundamentally important proposition, and that lies in a way at the heart of Capital Markets Union. I think the Vice President's absolutely right. I think as the UK detaches from the EU, it's incredibly important that the EU 27 develop their own approach to Capital Markets Union. I personally don't think it's impossible that the UK can't continue to contribute. There are some people who say, but hang on, Capital Markets Union has been going for 3 years, where's the proof? Well, I take the view that it's not just a great big bang, it's about a number of separate initiatives. I think of the 20 initiatives that Commissioner Hill initially announced, 13 have already been delivered. And only this week the prospectus directive has been reformed. So I think it's a case of slowly making the changes that are required. There are some areas that do need to be resolved, like securitisation, which is locked currently in the European Parliament. But we must make sure that Capital Markets Union is a reality, not just in the EU27, but ideally in the EU28.
Perfect. Well, Simon Lewis, thank you very much.
Pleasure.